With every quarter, we seem to achieve a new milestone, and this quarter is no different. Canada is gaining momentum with vaccine rollouts, with more than 16 million Canadians now fully vaccinated and a further 26 million who have had at least one dose. As we cautiously open our cities and strive for herd immunity, that's good news for all of us. I'm Mark Kinney, Chief Investment Officer of Newport Private Wealth, with your second quarter update. In another sign that light shines at the end of this long COVID tunnel, I'm delighted to be speaking from our office headquarters in downtown Toronto. We've had a core group of employees here throughout the pandemic. It's the first time I've been back since the initial lockdown last year, and it was great to see some familiar faces. We're gearing up for a return to the office later this fall. We are all excited to get back, especially since we have added 12 new employees since March of 2020. Against this backdrop of positivity, there's no question the quarter has continued to be volatile. In 90 days, we've had a year's worth of topics play out almost daily. Supply chain disruptions and pent-up demand, a red-hot real estate market and used car shortages, and the constant chatter of inflation and interest rates, to name just a few. Outside of market variables, one news item that's catching everyone's eye is the ongoing concerns about COVID resurgence and new variants. It's a reminder that the reopening will not be linear and that now is not the time for unnecessary risk-taking. Trying to distill 90 days just isn't possible, nor is it our objective today. We'll share how our disciplined investment approach has continued to generate strong performance across our mandates in both relative and absolute terms. The investments that Newport has access to benefit from our excellent manager relationships built over many years. Our shared investment philosophy and a rigorous process to assess investment opportunities continues to be a cornerstone of our approach. The results mirror this discipline. Newport's balanced portfolio finished the quarter up 7.78%, while our 5 proprietary portfolios posted mid-year returns between 6.29% and 9.22%. This places them at the high end of their target annual return ranges. Let's look at the factors that contributed to this performance. There's no question the bond market has been subject to volatility. Bond yields rose and bond prices fell to start the year. More recently, that trend reversed. Yields fell and bond prices rose, but they remained down on the year, resulting in negative returns. These swings will likely continue as the speed or slowness of the economic recovery works its way through the system. What it signals to us is a reinforcement of our strategy to remain underweight the bond market. With rates near 1%, the risk-reward potential remains unattractive. It also underscores the advantages of a diversified yield strategy, where we earn better returns from other sources of yield, such as private debt, mortgages, and income-producing real estate. The strong performance of our yield fund validates this, backed by solid returns from high-yield bonds, high-yield equities, mortgages, and private debt. The return of 6.5% year-to-date solidly outperformed the bond market, which lost 3.4% in the first half of the year. This outperformance supports our commitment to diversification and highlights the price sensitivity of the bond market to rising interest rates, an eventual long-term trend. What about inflation? As a recent New York Times article noted, consumers, economists, and bond traders often attempt to forecast inflation, but we really are walking in the dark. When looking at the rising price of goods and commodities, the word transitory seems to always appear as a reason to ignore it. Everyone is looking for pure data. The problem is it just does not exist. What we can do is make good investment decisions that meet our criteria for long-term growth and risk mitigation. Newport is disciplined by design, not driven by headlines. And when it comes to inflation, that discipline comes into full force. No matter whether the rise in prices proves to be short-lived or more lasting, or what happens with interest rates and inflation, we are comfortable with our positioning. Many of our yield investments, including private debt, have floating interest rates, which will benefit if rates rise. Real estate rental income is inflation protected as rents increase over time, and infrastructure assets have pricing power to raise rates over time. While inflation may be a byproduct of economic growth, our equity investments should also benefit from this outcome. Private debt, which consists of loans to private companies by specialist lenders, enables us to capitalize on the additional returns illiquid assets can provide. Our private debt managers continue to bring us great opportunities, and we also seek out new prospects on an ongoing basis. We recently allocated $20 million to a new partner, an experienced private debt lender in the U.S. who will make secured loans to mid-sized private companies. It gives us more diversification to the U.S. private debt market. Over numerous cycles, mortgages, public real estate such as REITs, and income-producing real estate have proven their value. They have both long-term appreciation and defensive strength during adverse periods. In addition to adding to our holdings in multifamily real estate in the U.S., we increased our allocation to a multifamily project located in the heart of Toronto. We first invested in this master-planned mixed-use community in October. The project will provide positive social impact with the inclusion of public parks, community spaces, and affordable housing. When stock markets are dominated by lower profitability companies providing the highest returns, it's easy to be distracted. Names like GameStop, AMC Entertainment, and BlackBerry have outsized returns that seem to defy logic. This is generally not sustainable in the long run. Our public equity managers continue to believe the way to create strong, risk-adjusted returns is to own the best businesses with sound fundamentals. Invest, don't speculate. Both our growth managers seek out high-quality, growth-oriented companies that have predictable cash flow generation, sustainable returns on capital, attractive growth opportunities, with experienced management teams. Their year-to-date outperformance is a testament to their skill in doing just that, with information technology and financial holdings the strongest performing sectors. We spoke last quarter about our focus on increasing international exposure with a $35 million allocation to an international small-cap mandate. Participating in the rebound of global economies is proving to be an astute move as the fund was up 7.5% in the second quarter. Our value managers also share a disciplined approach to investing in businesses that compound their worth over an entire business cycle. As one of our managers noted, history shows that over time, the price of a stock will rise or fall to reflect the true value of the underlying company. We are investing in companies trading at a substantial discount to their intrinsic value. The value component includes consumer staples and healthcare, sectors that are well positioned to cope with higher inflation. With the current portfolio of inexpensive, stable earning businesses already producing strong cash flow, it is primed to protect and grow capital long term. We are often asked by our clients about managers with whom we have long-standing relationships. These relationships give Newport a unique vantage point from which to do two things. First, we have built our public and private asset classes platform over 20 years. In that time, it has greatly evolved with refinements made through experience and increasing expertise. Secondly, our larger size gives us access to a broader set of opportunities not readily available to many. These opportunities enable us to give you premium investments through our mandates. There aren't many managers who meet our exacting standards, and it's why we're confident in the relationships we have and continue to grow with them. Our goal in choosing our managers is to look for companies that have unique skills, complementary offerings, diversification, and the same approach to risk and reward that Newport does. Brookfield Asset Management is one such manager. Many of you would be familiar with the Brookfield name. Brookfield is a premier global asset manager headquartered in Toronto and New York. With a market cap of over $100 billion and over $600 billion of assets under management, Brookfield invests in sectors where it believes that its in-depth operating experience gives it a competitive advantage. Newport has long been an investor with Brookfield. From our first commitment with them in 2013, we now own their public stock and have investments in their private equity, infrastructure, and real estate holdings across all of our mandates. In the quarter, we made a new commitment to Brookfield for $20 million to a fund that invests globally in mature and core infrastructure assets. Brookfield's infrastructure group owns and operates high-quality, long-life assets that provide essential services to the global economy. They have an established track record with $95 billion of assets under management in infrastructure investments. We were attracted to the stable income, diversification, and inflation protection provided by the fund. It's a prime opportunity to participate alongside one of the leading owners and operators of infrastructure assets. It's also a reflection of the strength of our long-standing relationship, our deep understanding of Brookfield's business model, and our trust in their ability to deliver results. Having the right partners is one part of the equation, but none of that matters if we don't hold true to our goal to manage portfolio risk while increasing the consistency, repeatability, and quality of the returns. That goal is not undertaken lightly. We invest your capital, we don't speculate or gamble with it. Just as ensuring the right cash flow is in place for you for the long term, generating cash flow for your investments is equally important. As we generate returns from our mandates, we're able to be acquisitive and opportunistic now and in the future. We're pleased with the quarter's positive relative and absolute performance. With the third quarter upon us, we have our sights set on how we will best preserve your capital in the face of likely continued and rising volatility, all while still generating cash flow and returns. As we have said, our job is to not try and forecast our way to good performance based on today's news. Performance is the result of long-term decision-making. Results are not dependent on outsized risk-taking, and our process will not be abandoned to chase short-term performance. Your wealth is being managed with the utmost care and diligence. As always, we thank you for your continued trust and confidence in Newport. Have a healthy, safe, and fun summer.